529 plans. What is that? Hey taxpayers, Tiffany Gonzalez here, your go-to finance expert and CEO of Accounting to Scale. Today we're talking about 529 plans. If you're a parent, planning to be one, or even a grandparent thinking about the next generation in your family, this video is for you. So what exactly is a 529 plan? It's a special savings account designed specifically for education expenses. It started back in 1986 as a way to prepay college tuition at today's rates, but over time. And it's now evolved into a much more powerful tool for building tax-free education savings. Here's how it works. You open a 529 plan and designate a beneficiary, usually your child or grandchild. But fun fact, you can actually list yourself as the beneficiary and update it later if needed. You contribute money invested in things like ETFs or mutual funds. You let it grow tax-free. Then, when it's time for college, you can withdraw the funds for approved education expenses, also tax-free. That includes tuition, school fees, supplies, and even room and board. Now let's talk about contributions. You can put up to $15,000 per year or $30,000 with a spouse without triggering the gift tax. But here's a smart strategy. If you have the cash, you can front load up to $75,000 at once, $150,000 if you're married, and spread it out over 5 years. Still gift tax free. So what's the catch? You can't deduct your contributions from federal taxes, but some states do offer tax breaks. So just check with your tax pro to see if you qualify. A big question I hear all the time is, what if my child doesn't go to college? Do you lose all that money? No, you can roll the 529 plan over to another child, to a grandchild, or even to yourself if you decide to go back to school. You've got options. There was also a big update in 2017. You can now use the 529 funds for K through 12 private school tuition up to $10,000 per year. But here's the thing, I don't love this strategy. If you contribute and withdraw the money too soon, you really miss out on the power of a 529 plan, which is the long-term tax-free growth. If you're saving for private school, a regular savings account might actually make more sense. Now, let's clear up some confusion. 529 plans versus prepaid tuition plans. A prepaid tuition plan locks in today's rates for a specific state college. It's predictable, but it limits your options. A 529 plan, on the other hand, gives you total control, and you decide how much to save, where to invest it, and which school your child attends. If you want the flexibility and the growth potential, the 529 is going to be the better choice. One last thing. Before you put money into a 529 plan, make sure you're prioritizing your retirement savings first. I get it. You want to do everything you can for your child's education, but your child can take out student loans if needed. You cannot take out a loan for retirement. If you don't save enough for yourself, you might end up relying on your child financially later on. And that's not really the legacy you want to leave, right? Previously, I mentioned $15,000 and $30,000 as the contribution, but I want to make you aware that that amount changes each and every year with inflation. The amount is essentially the amount you can gift without being subject to a gift tax return for that year. Do you have a 529 open for your beneficiary? Let's chat about it in the comments below. Hit the like button and subscribe to our YouTube channel. Until the next video, your favorite CPA, Tiffany Gonzalez.